So a state-owned investment firm in Abu Dhabi in the UAE has taken out billions of dollars worth of shorts in US stocks. But not only that, they have shifted their portfolio into short-term US Treasuries. Now, this is a sharp contrast from what they did back in October 2022, which so far is the bottom of this bear market. Back in October, they plowed $10 billion into US stocks. And as you can see here, the company took profits on some of its investments in US markets late last year, and now they've built a short position worth of billions of dollars in US stocks. Now, there are a slew of roadblocks that the US economy and in turn the global economy are up against. Obviously, we have the fastest rising interest rates in history. We have a growing credit crunch. We are obviously still battling inflation, although things on that front do look optimistic and promising. However, we are far away from the 2% target. We obviously have our own issues with the debt ceiling crisis, which I did a video on yesterday. Check out that video here on the debt ceiling crisis. I go into exactly what the debt ceiling is, what is the crisis, and what are some of the risks and implications of what we are currently facing with regards to the debt ceiling. And because of the debt ceiling crisis, treasury yields are spiking, which is part of the reason that the Royal Group in Abu Dhabi has poured into treasuries. And we will dive into more of each of those in this video. But the one thing that makes it significant is that economists also cite rising oil prices as a threat to a potential early recession. Some economists, including economists at Bloomberg, are predicting the US to slip into a recession as early as July. Now, if we take a look at oil, at crude oil futures weekly chart, you can see here that crude oil is at a low that we saw back in June 2021. So almost a 2-year low here for crude oil. And there have been talks that at the next OPEC meeting, we will see production cuts. And production cuts obviously raise the price of oil. And the interesting thing here is that the UAE is part of OPEC, one of the biggest players in OPEC. So is this a precursor of things to come? Are we going to see rising oil prices by a significant production cut, thereby adding to the long list of pressures that I just discussed, making a recession or a downturn more likely? But they bet billions of dollars in shorts on the US stock market. Now, the funny thing is, if you take a look at the article, it says that the amount is undisclosed, and it made it seem like the article was somehow leaked. However, nobody would have known this if they didn't leak it themselves. So obviously they want this to be known information, whether to try and spook the market further or send a message to the US government that the Gulf has been a little bit at odds with the US government now, especially with regards to not agreeing to increase oil production. So not only is this meant to, I think, project a little bit of fear into investors, right, to help their short positions, but also I think it sends a political message as well. That's just my take on it. And if you look at the S&P 500 here, you can see that the S&P 500, if you've been following it, doesn't take a genius to know that we are at major resistance. This 4,200 levels major resistance for the S&P 500, especially with the talks of the debt ceiling, with there being a potential X date on June 1st, which is what, 2-3 weeks from this video. Now, I happen to be in line with what Druckenmiller recently said. He said that they don't have a significant short position or a significant long position, and they are remaining extra cautious. Obviously, they also have positions in treasuries. Again, why wouldn't you have a position in treasuries when the bond yields look insane because of some of the uncertainty and volatility that we currently see? You know, we have the 1-month treasury sitting at 5.7%. That's just insane. But I happen to agree with Druckenmiller that there isn't really, in my view, heavily short is not a comfortable position, but neither is being heavily long, because obviously we have the list of things that I just discussed. We have the debt ceiling impasse. We have rising interest rates. We have the bank failures. We obviously have a credit crunch, both in the corporate and consumer sector, but we also have trending down inflation, PPI also, which tends to lead CPI. And I did a whole video about this as well, came in less than expected. And we can use that as a leading indicator that the CPI will continue to go down, right? So we are winning the fight on inflation. Inflation is not in a good spot by any means, but it is trending down while unemployment is still historically low. So there are positive things. This is not just an all-out, barrage of negative news, but there are definitely a lot of potentially negative headlines as well. So in my view, I think this is a time to be very cautious. I would not be confident holding a large short short position here, you know, aside from day trading or swing trading. But let me just talk a little bit in details about some of the causes for concern for the market here. So as I said, a credit crunch. We are now seeing a credit crunch, the likes of which we haven't seen since the pandemic, and before that, since the 2008 great financial crisis. And a credit crunch is basically exactly what it sounds like, when banks stop lending out to consumers and corporations. Now, what happens when banks stop lending out? And obviously they're not lending out as much because they are fearful, since interest rates are so high, payments are also going to be high, but also there are the risk of bank failures, right? And engaging in too much risky behavior, which right now banks have to be more careful than ever. So what happens when we get a credit crunch like this? Well, if people don't have money to spend, then the spending stops, right? So that's one. As I said, we have a debt ceiling impasse. If you take a look at the credit default swaps right now, and it's actually higher than this. This is an older chart. It's in the hundreds now, but right now it's the most expensive ever to insure a 1-year treasury. The 1-year US treasuries look worse in terms of risk than countries such as Greece or Mexico, because we have hit that debt ceiling or that debt limit, and we are still at an impasse as to whether the government is going to raise it or not. Now, I personally think that the government is going to raise the debt ceiling, as I said in my video. However, that doesn't mean that the rating of US debt cannot be affected. We saw in 2011, and I'm just going to pull up the S&P chart here from 2011 and show you exactly what happened. The US debt was actually downgraded because the agreement on the debt ceiling was pushed until the very last second, just a couple days before the deadline, and the S&P 500 hit a bear market, down 21.5% during that time. A default is not the only negative outcome of this debt ceiling crisis, right? We can get our debt downgraded once again, in which case it will cause short-term or midterm turmoil to the US economy as well as the world economy. The difference is in 2011, we were actually recovering from the 2008 financial crisis, right? And interest rates were at zero. Now we have interest rates at 5.25%, somewhere around there. The fastest rate hikes ever. We have a credit crunch, all the other things that I discussed. And so adding on top of that, a debt ceiling impasse that causes a US credit downgrade or US debt downgrade could be very catastrophic, because we have all of those other pressures slamming down on the economy, very much unlike what happened in 2011. As a matter of fact, as of the time of this recording, as I said, we are 2 to 3 weeks away from that June 1st deadline, and Jamie Dimon, who's the head of JP Morgan, is holding a war room once a week to prepare for potential negative outcomes from the debt ceiling crisis. Jamie Dimon said he will convene his war room more often and expects to meet every day. They are obviously not going to be meeting that frequently if it wasn't a risk. Like I said, a default isn't the only negative outcome. I do think they will eventually raise the debt ceiling. I don't think the US will default. Let me just say that for the record. And lastly, because I don't want to leave you guys without any potential solutions, I'm going to tell you what I'm looking at from a trading and investing standpoint. And again, if you want access to all of my analysis, alerts, stocks, options, futures, long-term investments, etc., click that link in the description below. It will be your fastest track to go from not knowing how to trade to learning how to trade and invest. Book an appointment with one of our ambassadors, apply to the Traveling Trader Academy, and if you're approved, you will know right away. So in this case, if we do see a drop, obviously a 22% drop like we saw in 2011, I'm going to be buying up stocks like crazy. I'm going to be buying the fear, because as I said, I do think the debt ceiling will be resolved. We've raised the debt ceiling over 90 times in the 20th century. We've never not raised the debt ceiling, regardless of administration, regardless of president, regardless of whether we were in a war or not, regardless of the economy, whether we were in a boom or bust cycle. I do think we will raise the debt ceiling. Now, that's not to say that I don't have disagreements with the whole debt ceiling mechanism, but that's a story for another video. But if we do see a drop, of course, I will be buying like crazy. I also mentioned this in my previous video, but I am also looking at 2-year note futures to buy into heavily when the debt ceiling is resolved and when the Fed pauses. I think these will skyrocket as the 2-year yield slams. And then lastly, I made a whole video how I go about buying my short-term treasuries. Right now, the short-term, the 1-month treasury is at 5.7%. This is over a 20-year high. The 2-month is paying almost 5. The 3-month is paying 5.2. These short-term treasuries are paying gold right now, right? Once this period actually ends and we win the fight on inflation and it's over, you are not going to see these rates anymore. This is going going to go bye-bye. So I'm taking advantage of this risk-free, well, we'll see if they don't raise the debt limit, but I'm taking advantage of this risk-free return here and piling my money into treasury yields that are now higher than the inflation rate, meaning that at worst, you are not going to be losing money to inflation, and at best, you will be making a return on your money. So again, if you want access to all of my analysis, alerts, etc., you want to know every single move that I'm making, you want to trade with thousands of traders who are exchanging ideas and strategies every day, continuing to improve each other, click that link in the description right now. Let me know your thoughts about the large short position that the UAE took out on US stocks. Let me know if you have a short position yourself, whether you are long. Do you think that it's all BS and they're trying to induce panic to cause people to sell? Do you think that they know something about impending oil production cuts and that's the reason they're taking out shorts, because they know that they're going to cut oil production and let oil prices skyrocket? I'm curious to hear from you guys. I try to respond to each and every comment. Yes, even the mean ones. Leave a thumbs up if you got anything out of this video. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.